We spend so much time thinking about money in terms of, well, stuff we can buy. But what if its real power is something way more important than that? The real goal isn't just about getting rich. It's about freedom. It's about having the ability to wake up one morning and say, you know what? I can do whatever I want today.
Okay, so that sounds great, right? But it brings up a huge question. If investing is the path to that freedom, why does it feel so impossibly complicated? I mean, the second you decide to start, you're just hit with this wall of jargon and conflicting advice and a million different choices. It almost feels like it's designed to be confusing.
So before we can even get to the solution, we really have to understand the problem. Why exactly does Wall Street feel like this crazy, chaotic casino where the odds are stacked against you? Well, for starters, we worry all the time about the risk of losing money in the market. But what about the guaranteed loss that happens when you do absolutely nothing? That's inflation. It's this silent thief that just eats away at your savings. Every single dollar you have tucked away is slowly but surely losing its buying power. And that newspaper example is perfect. The paper is the same, but what our dollar is worth, that has changed big time.
And it's no wonder we're all a little nervous. I mean, look at history. It is just littered with these wild, speculative bubbles where prices completely disconnect from reality. We're talking about everything from tulips in the 1600s to internet stocks in 2000. People get swept up, they're convinced, this time it's different, and then, poof, it all comes crashing down. It makes the whole market feel completely irrational.
And here's maybe the most confusing part of all. The experts can't even agree on what makes stock prices move. You've got one camp, the firm foundation folks, who believe every stock has the solid calculable value. And then you have the other camp, the castle-in-the-air theorists, who say, nope, a stock is only worth what the next guy is willing to pay for it. So it's basically a battle between cold, hard math and mass psychology. I mean, if they can't agree, what chance do the rest of us have?
And all this confusion, it leads so many of us down this really tempting path, the quest to be the genius, the one person who can outsmart everyone else. If the market is a puzzle, then surely someone can solve it, right?
And this is where you get the two main schools of thought for being a market wizard. You have the technicians, who are kind of like financial fortune tellers. They're staring at charts, looking for patterns they think will predict the future. Then you have the fundamental analysts. They're more like detectives, digging through financial reports and company data, trying to uncover a stock's true worth. Both paths are incredibly complex and honestly a huge time suck.
But here is the brutal, honest truth. Let's look at the people who do this for a living. The super smart, highly paid fund managers. The data is just overwhelming. Over any meaningful amount of time, the vast majority of them fail to beat a simple market average. Look at that. Over 10 years, more than 9 out of 10 of them underperform.
It's what the author Charles Ellis called the loser's game. It's a game where the harder you try to win by picking stocks and timing the market, the more likely you are to lose. You lose to the person who just owns the market and does nothing.
So why is it so hard? Well, because the world is totally unpredictable. A random event can change a company's future overnight. Accounting can be, let's call it creative. Analysts often have incentives to be optimistic, not necessarily accurate. And this is crucial, the very act of trying to beat the market, all that buying and selling, plus those high management fees, it creates costs that just drag your returns down.
Okay, so if trying to be a genius is a losing game, what's the winning one? Well, it turns out it's this beautifully simple idea that flips the entire problem on its head. Instead of spending all your energy searching for that one winning stock, the needle, you just buy the whole haystack.
This is the core insight from Burton Malkiel's classic book, A Random Walk Down Wall Street. Just stop playing the stock picking game. Own a little piece of every major company. If you do that, you are guaranteed to capture the return of the overall market.
And the tool that lets you do this is called an index fund. Just think of it like a basket that holds tiny little slices of all the big players, like the 500 largest companies in the US. You buy one share of that fund and, boom, you instantly own a diversified portfolio. Its goal isn't to be clever. Its goal is to just be average. And as we've just seen, being average is a fantastic winning strategy.
And why is capturing the market's returns so powerful? Because over the long haul, the stock market has historically returned an average of about 10% per year. By just owning the haystack, you get to harness the entire engine of capitalism and economic growth without all the stress and fees of trying to be a stock-picking genius.
All right, this all sounds great in theory, but how do you actually do it?
Well, the good news is that putting this simple strategy into practice has literally never been easier or cheaper. So let's open up the toolkit. So the two main tools you need to know about are ETFs and robo-advisors. ETFs, that's exchange-traded funds, are basically index funds you can buy and sell instantly through any online brokerage, often with zero commission. And robo-advisors, they take it a step further. They'll build and manage a whole diversified portfolio of these low-cost funds for you, all based on a simple questionnaire.
And the process itself is surprisingly straightforward. Seriously. First, you choose an account type, then you open it online, which takes like 15 minutes, connect your bank to transfer some funds, and then you buy a single broad market ETF. And that's it. You've done it. In 4 simple steps, you've gone from being a confused beginner to a disciplined long-term investor.
Well, wait. The strategy is simple, the tools are easy. So what's the catch? Well, the hardest part of investing has absolutely nothing to do with stocks or funds. It's the inner game. It's all about mastering your own mind.
This quote from Morgan Housel's brilliant book, The Psychology of Money, is the single most important lesson of all. Your success as an investor won't be determined by your IQ or how good you are with spreadsheets. It's going to be determined by your ability to control your own emotions and just stick to the plan. Let me tell you about Ronald Reed. The man was a janitor and a gas station attendant. He wasn't some Wall Street wizard. He just saved what he could, invested in solid, well-known companies, and then he did the hardest thing of all. He waited. For decades. His small, consistent actions compounded over time into an $8 million fortune. And that just proves it. Building wealth isn't about brilliance, it's about behavior. So what does this all really boil down to? The real skills here, they're not about finance. They're about character. It's about patience, letting time and compounding do all the heavy lifting for you. It's discipline, which really just means not freaking out and selling when the market inevitably drops. And it's consistency, making saving and investing an automatic habit. These are the traits that build real, lasting wealth. So as we wrap this up, I want to leave you with this one question because it reframes the entire goal of investing. The most important question you can ask isn't, how can I get the highest possible returns? It's, what is the strategy that I can actually stick with through good times and bad for decades to come? And for most of us, that's the simple, powerful act of just buying the haystack.